It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Japanese stocks tumbling for a second day as expectations grow of further rate hikes from the BOJ. The yen still trading around its strongest since March. A tech sell-off extending in Asia following disappointing forecasts from Amazon and Intel, while China remains a weak spot in Apple's results. And global treasuries on their longest winning streak in 4 years on the prospect of a Fed pivot. Swaps traders now pricing in 3 US rate cuts this year. All right, let's check on markets now. A lot of red on the screen. Avril Hong's in Singapore. Avril, what's going on?
Paul, it looks like a bit of a bloodbath in markets today. I mean, there is no appetite for risk. Investors are really worrying that the Federal Reserve is behind the curve when it comes to easing. Can the U.S. economy wait until September for cuts, especially given what the data is telling us? So pulling all this risk off the table, we're seeing stocks slumping on the Asia stock gauge, the biggest bleed in 2 years. We're also seeing really strong concerns coming on the infotech sector, given the earnings that we got from Intel and Amazon. They disappointed. That is the sector that is losing the most ground on the Asia stock gauge today. On Japanese equities, the added concern of BOJ rate hikes. Maybe we get 0.5% by the end of the year. That is an uncomfortable situation for equities there. The Topix has slumped by 10% since the peak that we saw in July. All the sectors on this index down for a second day. And amid all this risk off, we're actually only seeing a bit up in the dollar and gold. Even the yen is giving up some of those gains. Let's flip the board because that is an uncomfortable situation for even Asia currencies. Even if we see the Federal Reserve cutting rates, investors might not want these currencies that are seen as a bit riskier. So we're seeing the Korean won, the Taiwan dollar, also the declines exacerbated by stock market outflows. And interestingly also, today we got the PBOC from its fix. It seems to be signaling that it wants narrower spreads between the yuan fix and the spot rate. We're seeing dollar, China, both offshore and onshore, they are converging towards that 723 level. And this is also on a day where a PBOC advisor has issued this rare critique of China's economic policies. It really shows you how dire the situation is in China, the world's second largest economy. And this is really showing you how the headwinds abound for markets today, Paul.
Yeah, well, we heard from Jay Powell this week as well saying, oh, look, maybe we can cut rates in September. The market's decided, well, maybe we're on track for 3 this year, especially after that US data that we saw.
Yeah, absolutely. I think it's really about the data that we saw overnight, and that is cementing the concerns about labor market weakness. Job openings, ADP is not so bad, but where we really saw the concerns was coming through from the initial jobless claims. It jumped to the highest in a year, and a lot of these claims were coming out from the states of Missouri and Michigan, key manufacturing states. We also got the ISM factory activity contracting at the worst pace in 8 months. So all these concerns, as you say, Powell has acknowledged the risks in the labor market, the job hiring slowing, the jobless rate ticking up. So this is just, waiting for that confirmation potentially from when we get non-farm payrolls later today to see how bad things really are. Bloomberg Economics also highlights something that is worth keeping an eye on, is that the hurricane in July also might be showing up in the data. Flip the board. Ahead of all that, treasuries are rallying really, really hard. It's extending the gains from overnight already. On the 10-year, slipping below 4% for the first time since February. Westpac sees 3.8% if we get a bad payrolls print. And we're also seeing on the 2-year hitting the lowest already since 14 months ago, Paul.
All right, thanks very much, Avril. Plenty here to unpack now with our first guest. Gary Dugan is CEO of the Global CIO Office. And Gary, the scene now set as far as markets are concerned for potentially 3 rate cuts, as Avril was explaining there. I just want to get straight to our question of the day. How long do you think it's going to be before the Fed rate hits 4%?
Well, very soon. I mean, I was one of those advocating they should have cut at the last meeting. I mean, I think there's a real soft underbelly to the U.S. economy at the moment, compounded by the clear weakness in places like Europe very recently, and of course in China. And central bankers are behind the curve and will have to accelerate their cuts in interest rates.
Yeah, are we looking at perhaps, in a few months' time, we might be having a conversation around a policy mistake?
Oh, absolutely. I mean, I think in coming days, there may even be a discussion about whether the Fed will have to cut by 50 basis points at their next meeting in order to catch up with the clearly the loss of momentum in the economy. There's been not just some of the data telling this, the companies are saying it, whether it's in the luxury goods sector through to the PepsiCos and some of the other companies selling to the less well-off.
It's been interesting looking at some of the movements in the bond market as well. Bonds now on their longest winning streak in 4 years, but also that spread between the 2s and the 10s are getting narrower and narrower. And, that inverted yield curve for a long time now has been flashing potential recession. Could this potentially be it? Are we staring down the possibility of maybe not a soft landing, but a contraction?
We are. And, I think had the central bankers moved a bit earlier, then we could have perhaps stayed this off. But the direction of travel at the moment, and particularly when we saw that survey yesterday from the ISM on the manufacturing sector, key indices such as on employment and headline confidence are dropping like a stone. And that's not really a controlled situation. It's not a situation where you think just a 25 basis point cut come September is going to help. It's going to have to be much more aggressive in terms of central bank policymaking.
Well, if we are looking down the barrel of 3 potential rate cuts this year, when you see all the selling that's taking place today, do you buy this dip or is it a falling knife?
Unfortunately, it's a bit of a falling knife at the moment. I think a lot of people have made the argument for some time that U.S. equities and tech were well overextended. I'm not so sure the rest of the world should follow that because the valuations were more reasonable. But from the peak, a 10 to 15% correction is not wouldn't be strange in this huge change in shift in sentiment in the markets and central banks that look well behind the curve.
I just want to talk about the Bank of Japan briefly as well, because there is an expectation that we might see more tightening again this year. What do you see as the risks around that and potentially snuffing out some of the gains that have been made on inflation?
Yes, I'd be surprised if they kept barreling on, particularly if the global backdrop is not good. So a further increase in interest rates, I think, would be seen as, quite frankly, madness in an environment where you're facing at least some kind of significantly elevated risk now of a global recession, perhaps centered on the US and with the clear weakness in China. So unless we see some very dramatic changes elsewhere, I think the Bank of Japan should be cautious in any other further increases over the next 3 months.
Well, there are some other risks to consider as well. We have the tension in the Middle East, and also the US election landscape just keeps on changing as we see some of these Trump trades unwind. Where do you see those trades heading?
Yeah, I think the momentum at the moment seems to be with Harris as opposed to Trump. So that's pulling people back from putting those, I suppose, putting the anti-Trump trade on. But I think the issue here is that people are jumping into domestic plays in the United States on the assumption of rapid cuts in interest rates. Well, they're not yet apparent. And secondly, we'll have to go through a recession or a very slow phase of growth. And as we've seen amongst Dow Jones companies at the moment, their earnings are falling far quicker than the tech sector. So, do you really want to be buying companies that are seeing downgrades to earnings forecasts and in the absence of aggressive monetary loosening?
All right, Gary Dugan of the Global CIO office is sticking around. Coming up, we're going to discuss the tech sell-off continuing in Asia following disappointing forecasts from Amazon and Intel. Apple also flagging weakness in its China business. Plus, Adani's flagship unit reports a 115% jump in second quarter profit. We'll break down its results next. This is Bloomberg. Welcome back. Let's get a quick recap of big tech earnings we got out of the US. Apple reporting better than expected revenue growth in the quarter that ended in June. Sales, though, in China fell by 6.5%. The company says it sees upcoming AI features spurring a wave of upgrades by its customers. Amazon sales fell short of estimates. Its profit forecast for the current quarter also missed Wall Street projections. The cloud business was a bright spot, revenue there jumping by 19%. And Intel shares also falling in late trading after it said sales for the current quarter will be below analyst expectations. The company also sees a loss of 3 cents a share, and the chip maker says it's cutting more than 15% of its workforce and suspending dividend payments. Well, Gary Dugan, CEO of the Global CIO Office, is still with us, and he believes that tech is the sector to own for the medium term. And Gary, much like a lot of equities today, we're seeing some pretty heavy selling in the tech sector. I asked this question a little bit earlier. Do you buy at this moment, or do you just hold off a little bit?
I think you hold off a little bit, but you've got to keep in the back of your mind, this is a sector with a great future. If you look at the old economy companies, they're going to have to wait for substantial cuts in interest rates and consumer confidence that comes back. But there's still a wave of huge capex cycle going on in the tech industry. There will be bumps, of course, and particularly when companies are running short of cash, as they may be at the moment. And to go back to the comments made by Apple, AI means a very significant upgrading required by consumers and companies around the world. And that theme continues, recession or no recession.
One of the questions, though, and this is one that Apple hasn't really explained, is how do these AI features generate revenue? Do you have some concerns about the amount of spending that's going on in this space with not a lot of profit to show for it so far?
I suppose when you've got a brand new technology, that tends to happen. But yes, I think there's probably just been too much hype, too much excitement. And you can imagine within some of these companies, people have made very passionate arguments for spending lots of money on the basis that AI is going to transform the world. That kind of hype can lead to decisions which are not good ones, and you will have to take some losses or say that you've just got a few things wrong through a still very positive cycle. So we could be in for a bumpy ride, but I think any significant downside on this sector should be seen as a buying opportunity. Whereas in the broader market, you'd say, well, why do I need to do it today? In tech, I think you still need to have a significant exposure in your portfolio.
Yeah, I'm wondering here if you do get a sense of shades of the dot-com era of the 90s. And with that in mind, I mean, obviously the internet is just central to the entire global experience now. How long do you think it's going to be before AI reaches that sort of level?
I think there's some way to go. Although, when you go back and look at what was happening at that time, there were business plans with absolutely no substance. Just remember some of the stories at that time. When I was covering the markets. I think AI is different. AI is a significant game changer. It is, though, it could end up being, as I think we're always experiencing in our lives at the moment, that it becomes something of a commodity. So people shouldn't overplay the potential profitability. And maybe the part of the market that gets hurt here is the startups, where a lot of cash has chased some of the small and medium-sized companies that have just started up, seem to have a great business plan. But if there is a cycle here where we have a bit of a dip in capital spending plans of just your average company, that will take out some of these smaller businesses, but still leave the long-term trend and the opportunity there for the bigger players to take advantage of.
Mm-hmm. Okay, so you're holding off, as you said earlier, about buying in tech names at the moment. But is there anything that you are looking at buying right now, anywhere where you're adding to positions at the moment?
Well, again, if the client says you've got to get me fully invested, as often is the case, I think you just go back to, unfortunately, you go back to gold and to bonds here. Now, that 2-year has dropped, I think, 70 or 80 basis points in a matter of weeks. So you're thinking, is this the time to do it? But if the central banks really have to push on the accelerator of monetary easing here, we could still be surprised at how low yields go within a matter of months. And on the side of gold, and an environment of lower interest rates, you would typically want to buy gold. Whether the dollar goes up or down doesn't make a huge amount of difference to gold at the moment. And the geopolitical challenges around the world, again, lend itself to gold. So it's a store of value. I'm not saying you make 10 or 20% from here, but I do still believe that in 3 or 4 months from now, gold price could be at this level or higher, which may be better than other assets.
All right, Gary Dugan of the Global CIO Office, thanks so much for joining us today. And you can follow more on this story and all of the day's trading action on our Markets Live blog. And you can find that on the Bloomberg. MLIV Go is the command. And you can get a market rundown there in one click. There's also commentary and analysis from Bloomberg's expert editors. And you can find out what's affecting your investments right now. All right, keep an eye on shares of Adani Enterprises when trading in India starts later on this hour. The stock closed higher on Thursday after a 115% jump in quarterly profit. For more, let's bring in Bloomberg Conglomerates reporter PR Sanjay in Mumbai. So really strong profit jump there. What's Adani saying about the outlook?
Oh, this is, kind of a story which saying that the conglomerate, the port power conglomerate, Adani Enterprises, the flagship, is bouncing back from the brutal and scathing short seller report which happened in January 2023, and which is the great reflection of 115% rise in their net income, which is largely supplemented or complemented by their new energy ecosystem, which includes mining and airports. So this is like kind of a corroboration of these new energy ecosystem and new incubating companies are helping the conglomerate.
Yeah, so Adani's also looking at moving into copper, planning a share sale in the coming weeks as well. What more do we know about those ideas?
So the clear-cut story is is a continuous emergence of incubating companies. Airports are doing great. There are new airports coming in. Navi Mumbai would be operational by 2025 financial year, and their green hydrogen ecosystem is also doing great. And we are expecting, the management has already hinted that by 2027 to 2029 they would be demerging these matured incubated companies, the new companies, including airports. So we are expecting a kind of a potential demerger of airport holding company in 2027 to 2029, and they would be also listed apart from green hydrogen things. So investors are very keenly watching out what are the kind of a roadmap for the demergers of these incubated companies and when they will be matured and they will be actually yielding results for this conglomerate. That's what keenly watching out, and this Adani Enterprises is a clear-cut story of the continuous emergence of these matured incubated companies.
All right, Bloomberg Conglomerates reporter PR Sanjay in Mumbai on Adani earnings. And next week, we're going to have special in-depth coverage of the Adani Group. Beginning on Monday, we're speaking exclusively with Asia's second richest person, Gautam Adani, as he oversees a real-life succession story. We're going to meet the family members hand-picked to take over the conglomerate, controlling large parts of the infrastructure behind India's $4 trillion economy. Coverage culminates with a special report next Friday. Plenty more to come. This is Bloomberg. ARM shares closed sharply lower in New York after the chip design company held off on boosting its annual forecast. But CEO Rene Haas told us he's still optimistic about the longer-term outlook.
The way I think about it is as follows. This is our fourth quarter as a public company. It is our fourth quarter of record revenues. As you said, we smashed it last quarter, over $930 million of revenue. So super happy about the quarter. Last quarter, 90 days ago, we raised the annual guidance about 8 to 10%. So when we looked at the outlook for the year, 90 days later, coming off a great quarter, we just didn't feel the need to raise expectations again. So that's really just the backdrop. It's quite simple. We raised the guidance for the year last quarter. record quarter this quarter, and we're maintaining at this point.
Rene, is there anything you can tell me about specific markets that you serve where you see some caution or some hesitation, but you're also able to see whatever it is holding you back working itself out?
Yeah, remember, Ed, that we have two components to our business. We have the licensing business and the royalty business. The licensing business, which is really the forward indicator of demand for ARM technology, never been stronger. The licensing revenue year on year up 70%. What's driving that? That's demand for building new complex chips, more demand for ARM, more compute capability. So that is a harbinger of forward type of demand. Royalties were also up year on year, almost 20%, largely driven by smartphone growth, where units have been modest, but our new version 9 is driving high royalty growth. So in general, we're very, very optimistic about the long-term outlook, particularly because of the licensing activity being so strong.
One of the areas, Rene, you know that I cover a bit more deeply is automotive technology, and I'm just trying to draw parallels with different names out there, understand what's happening. Mobileye told us this morning, for example, that particularly in China, but globally, some of their customers just stopped making orders for the second half of this year. I understand that from ARM's perspective, it's different, right? You think about the pipeline of a specific chip that you're involved in the design of. It's much further afield, longer term. But do you see in that industry in particular any sort of either cyclical process happening or some specific weakness?
Yeah, I think the way we think about the automotive market is we are growing faster in terms of demand for our technology than the market itself. So we were actually up double digits last quarter in automotive royalties. And that's really a function of gaining market share, but more importantly, the quality of the technology that's going in is much higher. These are more complex compute platform devices. They run a lot of software, whether it's for IVI, EV, autonomous. So we're very, very bullish about the long-term automotive outlook. The near-term inventory issues that go back and forth, we haven't been impacted by that so much because, as I said, we're gaining share, and the complexity of our own technology being used just keeps going up.
All right, that is ARM CEO Rene Haas there speaking with Bloomberg's Ed Ludlow. Let's take a look at some of the things that are moving in markets, particularly here in Australia. I mean, pretty much everything's getting sold down right now, but uranium stocks are getting particularly badly hit. We've got Bannerman, Boss Energy, Deep Yellow, Paladin, all off by more than 10%. This was on the news that Kazakhstan's Kazatomprom expects to produce a lot more uranium this year than it did the previous year, raising guidance, and it's putting pressure on some of those Aussie uranium miners. Also seeing chip stocks really getting hammered in Asia at the moment, and this was after earnings from Intel and Amazon. Intel seeing third quarter revenue below analyst estimates. Amazon also coming out with lower than expected guidance. Plenty more to come on Bloomberg. This is Welcome back. We've got China markets just heading to lunch, and comparatively speaking, not doing too bad. The CSI 300 is only off by 0.2%. That compares pretty well to some of the selling that we're seeing elsewhere around the region. But there you have it. The CSI 300 a little bit softer. The Shanghai Composite also off by about 0.5%. We've got the offshore yuan there, 723.13. But yeah, it's been a very rough ride on markets today. China escaping relatively unscathed, but we've got the Nikkei off at the moment by getting on for 5% now. It's tech and chip stocks that are getting particularly hard hit today off the back of those earnings that we had from Intel and Amazon. Guidance from Amazon, as I was mentioning just before the break there. Really disappointing investors. The cloud unit, AWS, doing pretty well though. Intel shares though also slipped on revenue forecasts, so we're seeing that translate into quite a bit of a weakness for tech stocks in particular today. Elsewhere, we've got the Nikkei, beg your pardon, the yen losing a little bit of ground, 149.46 at the moment. But we have been hearing, we heard yesterday, in fact, that the BOJ may continue to tighten this year. Do wonder if that position might get reconsidered after some of the US data that we had a little bit earlier. We'll be getting US jobs numbers later on as well. Markets now forecasting that we might be getting 3 cuts from the Fed this year. All right, Russia has freed 16 prisoners in the largest swap deal with the US since the Cold War. Among those released by Russia were Wall Street Journal reporter Evan Gershkovich, as well as the former US Marine Paul Whelan, who had been detained since 2018. Now, the swap was in exchange for 8 Russians, including an assassin sought by Moscow. Vadim Krasakov was convicted of murder in Germany after gunning down a Chechen leader in Berlin in 2019. And we are awaiting those freed Americans' arrival at Joint Base Andrews near Washington. They're going to be greeted there by President Biden and Vice President Kamala Harris, and we're anticipating some live pictures of that in just a little while. But for more on this, let's bring in Bloomberg senior editor Bill Ferries. So, Bill, what were the circumstances leading up to this prisoner swap?
Well, we know that this has been some high-level and very intense diplomacy going back really well over a year, probably since Evan Gershkovich, the Wall Street Journal reporter, was declared improperly or illegally detained by the United States. That got negotiations going. There was a deal nearing reach early this year that many sides thought might be disrupted when Alexei Navalny, the Russian democracy activist who died in a Russian prison, passed away. That he was seen as a key part of that deal at the time, and there was concern that his death would disrupt things. But we know at the highest levels of government, including the Biden administration, with Chancellor Olaf Scholz in Germany, and 5 other nations, that it took a lot of talks to secure this agreement. 24 prisoners and hostages in total, 7 nations involved. And as you mentioned, we're just perhaps moments away from seeing many of those Americans who were detained land back in the United States and be reunited with their families and with President Biden and Vice President Harris.
Yeah, the spotlight to some extent had shifted away from President Biden after his decision not to contest the November election. But here he is negotiating this impressive hostage deal. Has his attention now turned to securing his legacy?
Well, it's interesting because we know now with some of the reporting that's gone on that President Biden was calling the leader of Slovenia just on the exact same day that he announced that he was stepping down from the presidential campaign. So a very busy day that day for the president. We know that he was discussing this deal with Olaf Scholz back in February before Navalny had passed away. I think this is clearly going to be one of the high water marks that he's been hoping to achieve after withdrawing from the race. It's certainly something that his administration has been talking about ever since Gershkovich was taken early last year.
All right, Bloomberg senior editor Bill Ferries, as we await those live pictures from Joint Airbase Andrews when those prisoners who are being held, I incorrectly referred to them as hostages. It was a prisoner swap, soon to be returning to US soil. There we see the live picture at Joint Base Andrews there. Large amount of media gathered for that arrival. Well, intense flooding around the world this year has killed thousands of people and caused economic losses estimated in the tens of billions of dollars, and that's shining the spotlight on countries' flood defences. Bloomberg's Avril Hong takes a closer look.
Wild weather this year has unleashed devastating floods around the world. From Switzerland to Dubai to Kenya and the provinces of southern China. Hundreds have been killed and hundreds of thousands more injured or evacuated. On top of the human toll, floods cause tens of billions in economic losses each year. The world's largest reinsurer, Munich Re, put last year's global damage at $48 billion, almost double the amount in 2003. The IPCC, the UN body that assesses the science of climate change, says weather extremes will only get worse in a warming world. That's increasing the urgency for climate adaptation. For land-scarce Singapore, part of the solution is this huge structure beneath the city's historic botanic gardens. The Stanford detention tank is designed to store excess stormwater from heavy downpours. The tank can hold 38,000 cubic meters of water, enough to fill about 15 Olympic-sized swimming pools. Floodwater is channeled here through a canal, all to protect the prime Orchard Road shopping district and prevent scenes like this from reoccurring.
So without the tank and without the diversion canal, Singapore's main shopping district will flood if we experience the same rainfall intensity that we had in 2010 and 2011. But with the construction of the tank as well as the diversion canal, our main shopping district is able to cater for a much heavier rainfall.
Projects like this don't come cheap. This installation cost $170 million to build. Not every country can prioritize spending on climate adaptation, but environmental engineers say not doing so would incur even greater costs.
The consequences are just unimaginable. If you multiply probability with the consequence of what would have happened if you are not protected, that even if it's extremely rare, but multiply with a consequence, it could become a significant, disastrous event.
Apart from preventing flood damage, adaptation projects can also pay dividends in other ways by attracting investment.
That actually gives reassurances to investors to, yes, this is the place in which you can continue to operate, run the business. This is the place where you want to build your data centers in. So that justifies the taxpayers' dollars.
So far, Singapore hasn't seen a repeat of the kind of flooding that prompted the building of the tank. For now, the massive facility mostly sits empty, but it's helping to future-proof Singapore, an example for other vulnerable locations in meeting the rising risk from extreme weather.
And Avril Hong joins us now for more on that story. Avril.
Yeah, Paul, obviously there are huge gaps when it comes to climate adaptation, and we want to pick the brains of Melissa Chalk. She's Associate Director of ESG Investment Research at Sustainable Fish. Melissa, there are these gaps, but there are also a lot of other priorities for governments. I mean, we're hearing about how major economies, including the US, seems to be slowing more than expected. How are governments going to prioritize these things, climate adaptation and climate mitigation?
I think you're right. As you said, that there is a lot of prioritization that has to go on. So ultimately, you have to do the cost-benefit analysis of what is worth investing at the moment. As you said, climate adaptation, there's a very big gulf in funding. In the Asia-Pacific alone, last year we accounted for 43% of natural disasters, which accounted for about 80 billion in economic losses. So ultimately, I think it's just about allocating capital where it needs to go and ensuring that investors get the right amount of return for their investments that they're doing for these various.
How big is the shortfall?
Well, there are various estimates out there. I think the IMF, or was it the World Bank, has it at about 1.1 trillion that's needed, and currently I think 800 billion shortfall for investing in climate adaptation. Ultimately, we're going to need concerted effort from governments, regulators, investors, lenders, all kind of channeling capital to where it needs to go.
Yeah, so multiple hands needed. But when it comes to government, does it matter when we look towards the November election, who is in the White House? Does that influence the kind of government spending we might see for climate adaptation?
Sure, that's a question that we get asked a lot by our clients as well. I think at this point, fears about a complete reversal of climate policy might be a little bit overblown. We need to remember that with sustainable finance and climate financing, it is driven by global factors. There's no stopping climate change from happening. And ultimately, we also need to remember that whoever is currently, the sitting president, the government is formed of a lot more branches than just the president. So there would be federal level government as well as local level government. We've seen California come out with their own regulations that support businesses in funding a lot of these things. So I think the fears at this point are overblown that we're going to see a complete comeback of anti-ESG sentiment.
Right, and we might even see states take the lead, as you mentioned, California. Yes. But when it comes to developing nations, obviously there's a potentially bigger gap, the gulf between what is needed and how they can even access that financing. How do you close that gap, particularly for countries like India?
Sure. So I think right now, a lot of the funding that goes towards climate adaptation comes from supranational organizations, so MDBs, national development financial institutions, and we're probably still going to see that, hold the bulk of adaptation financing or funneling the bulk of adaptation financing. What we really need is for private capital and institutional investors to come on board to bolster that gap, because ultimately, the pockets are the deepest there. And I think investors are waking up to the fact that there is benefit in investing in a lot of these climate adaptation projects, in conjunction with climate mitigation.
What are some of the instruments that they can invest in?
Sure, that might be a better question for investors, but from a bird's eye view, looking at the ESG data, especially from ESG labeled debt, we're seeing slowly an increase in the use of proceeds go towards climate resilient infrastructure, early warning systems, flood protections, landslide prevention. So those are just a few of the key areas that we're seeing funding go towards at this point in time. I think we'll see more go towards them as we see successful projects get executed and reported on.
Okay, now just very quickly, because we don't have much time left, but just wanted to pick your brains as well. When it comes to government, allotting this, there is also incentive for them to do so besides, just preventing floods. What else do you think is going to incentivize governments?
I think ultimately with investing in adaptation, you are safeguarding against future economic losses from natural disasters. So especially in Asia, where the bulk of manufacturing activities happen, we manufacture everything from electronics to semiconductors. So ultimately, investing ahead of time to prevent all these natural disasters from having severe impacts also ensures supply chain continuity globally. And you're also fighting against safeguarding public health safety as well as, jobs.
Part of that cost-benefit analysis.
Exactly.
Melissa, great to chat with you. Thanks so much
for coming in and
sharing your thoughts with us. Melissa Chok of Sustainable Fitch. Paul?
All right, thanks, Avril. Just want to get you across this headline, perhaps of no surprise to anyone at all. We've now got the MSCI Asia Pacific Index slumping by 3%. That's the most we've seen that index decline since June 2022. So no surprise considering some of the selling we're seeing across the region. We got the Nikkei off by nearly 5%. The Kospi off by 3.3%, the Hang Seng by 2%. Every sector here in Australia weaker as well, and the MSCI Asia Pacific now down by a little more than 3%. Plenty more to come. This is Bloomberg. All right, you are seeing live pictures of Joint Base Andrews near Washington, D.C., where we have a plane full of prisoners that have been released from confinement in Russia. This is the fruit of a very long process, a lot of negotiation between the US, Russia, and a number of other countries to secure the release of 24 prisoners who were being detained in Russia. There you see President Biden, Vice President Kamala Harris there approaching the plane. On board, we have the Wall Street Journal reporter Evan Gershkovich. He was convicted in Russia of espionage, a charge that he rejects. Also on board, former US Marine Paul Whelan. He was jailed in 2018 on spying charges, which he also denies. Elsu Kurmasheva, another one on board there. She's a dual US-Russia citizen. She was detained under censorship laws. She is also on board that plane. So we see there the President and the Vice President and presidential candidate Kamala Harris approaching that plane, waiting to greet those Americans who have been freed from Russia under that prisoner swap deal. So 16 prisoners in total heading west. 8 went back the other way to Russia, including Vadim Krazakov. He was convicted of killing a Chechen separatist in Berlin back in 2019. Russia was particularly eager to have that citizen returned home. So after this swap occurred in Ankara, the Turkish capital, this swap was completed. And there we have it, the first of the detained Americans stepping back onto home soil being greeted by President Biden there. So Evan Gershkovich, as I mentioned, convicted in Russia of espionage charges, a charge that he rejects. And we'll see exchanging words with the president there, who has worked very hard to bring these prisoners home. Now greeting the Vice President, Kamala Harris. So, yes, this was achieved after a considerable period of negotiations between the US, Russia, Germany, a number of other countries as well. So a very happy moment for those on board the plane to be returned to US soil. All right. Let's check Indian markets now. We have just had markets open for trade there. Take a look at how yields are doing. We have, of course, seen yields falling pretty much across the world at the moment, and Indian yields are joining this trend. We also have Indian stocks heading lower. The Sensex off by 0.8%. Not a great deal of change there for the rupee at the moment. We'll talk about that in a minute. But here we have the Indian yields now trading, or Indian bonds now trading. Been a lot of attention to this space since foreign buyers were allowed into the space, but yields falling today, as they have been pretty much across the curve and across every major market. So the yield on the Indian 10-year there, 6.905. Fed rate cut boosting Indian bonds, but we might now also see the RBI joining the rate-cutting party. Let's talk about India's growth outlook and the outlook for rates as well with Aditi Nair, Chief Economist at ICRA. Aditi, thanks so much for joining us. So even just a day after we heard from the Fed Chair Jay Powell saying, well, maybe September's live if the data passes the test. Well, we've had a lot of data under the bridge in just 24 hours. What's your expectation for RBI policy in the coming week, particularly after the Fed suggested that a September cut could be a possibility, and we've got markets now saying we might see 3 before the end of the year?
Thank you. Well, next week from the RBI, we're not expecting very much. We don't expect them to change the stance or, actually go in for a rate cut. But that tone might change just a little bit, given the fact that we've seen rate cuts being hinted at or being started already by some of the the major advanced economy central banks. From the Indian growth inflation dynamics point of view, the monsoon season is underway, and there's 2 months left, basically, for the monsoon season to get over. So we do think that the RBI will want to wait for the monsoon season to end before they actually change the stance in October.
Yeah, so when that stance does change, I mean, it's likely the RBI is going to ease at some point. The Fed's also going to be easing. So with that in mind, what's your outlook for the rupee? What's the trend line look like to you?
So from the RBI, we expect a stance change in October and a very shallow rate cut cycle, 225 basis points rate cuts each in December and in February. That's the baseline that we're working with right now. So a shallower cycle than the Fed. And on the rupee, broadly, our expectation is that with the foreign money coming into Indian bonds after the bond index inclusion, there is a general appreciation bias this year as opposed to the depreciation bias that we saw for a large part of last year. And added to that, we've got some recent a paper that has come out from the RBI that is suggesting that we might need to see banks holding more liquid assets going ahead, which would also step up demand for government bonds. So with all of this, we feel that yields will probably moderate, and we do think that the rupee should generally have an appreciation bias going ahead, unless there are some global shocks. So there is a larger global tendency for EMs to depreciate. So we're working with a band of 84 on the downside to the dollar and 82.5 on the upside for the Indian rupee.
Didi, I'll rejoin the conversation in a moment. I just wanted to describe to our viewers what they're seeing on the screen right now. This is, of course, Joint Base Andrews, where a number of US citizens are returning after being held in detention in Russia. We're seeing some tearful reunions there, a greeting from President Biden and Vice President Kamala Harris as well. So an emotional moment there on the tarmac at Joint Base Andrews as the families of those detained Americans welcome them back to home soil. All right, Aditi, let's get back to things in your part of the world meanwhile. In terms of the weakness in the rupee, do you anticipate maybe we might see some intervention from the RBI to do something about that? And do you feel that that would be effective?
I do think so. The RBI has very large reserves right now, and I do think that they will be willing to use them to be able to stabilize the rupee. They've said several times in the past that their intention is basically to, just ease off the volatility in the market and have a more sort of stable trend as far as the rupee is concerned. So perhaps that will happen, especially with the kind of increase that we've seen in reserves over the last couple of weeks as well, over the month of July, since the bond index inclusion actually happened.
Just want to talk about fiscal policy as well. We've seen government capex decline just in the few weeks since the election, and it didn't really spend its budgeted capex in the 2 prior years either. What do you feel the implications of this might be?
So, this year we had an interim budget target for capital expenditure of 11.1 trillion. And the sense we had was that that was already going to be a pretty challenging ask. It was a growth of 17% over the amount that was spent last year. And typically when the election season is underway, we don't see a whole lot of capital expenditure, happening. So project execution does tend to slow down. And that's exactly what we saw in the first quarter. The numbers are indicating a large contraction in the Government of India's capital expenditure, and also, in fact, in the state government's capital expenditure, for whom we have data for just the first 2 months of India's fiscal year. Now, going ahead, as I was saying earlier, we're in the middle of the monsoon season. Typically, project execution remains slow until about September, when the monsoon starts retreating out of India. So we have about 7 months effectively left in the fiscal year for a huge amount of capex to be undertaken. And I do think that there is a probability that there will be a miss on the headline capital expenditure target of 11.1 trillion in FY25.
All right, DT Nair, Chief Economist of ICRA, thanks so much for joining us. Just want to check in on how the Adani Group, its enterprises and other attached companies are doing in India trade at the moment. Of course, we're seeing the broader Indian indexes somewhat softer, but then again, everything is today. We did, of course, have results from Adani Enterprises, a huge 115% jump in quarterly profits. That was boosted by solid revenues at airports, the mining business performing strongly as well. And even this is coming after that scathing attack from short seller Hindenburg last year. We also hear news that Adani will be exploring opportunities in the copper business as well. And Adani also looking at selling off portions of its business as well. Data centers, green hydrogen, consumer goods division might be sold as well. I beg your pardon, it's just the consumer goods division that is being looked at being listed. Next week also we're going to have a special in-depth coverage of the Adani Group. That's going to start on Monday, and we will be speaking exclusively with Asia's second richest person, Gautam Adani himself, as he oversees what's turning into a real-life succession story. We'll meet the members of his family that he's handpicked to take over the conglomerate, controlling large parts of the infrastructure behind India's $4 trillion economy. Our coverage will culminate next Friday with a special report. All right, let's take a look at market checks more broadly. And red is the theme of the day. We're seeing some pretty heavy selling. The topic's now entering correction. It's down 10% from its July peak. Right now, down 4.6% on the day. It's now just below its 200-day moving average. So we'll see if major support lines hold from here. Tech particularly bearing the brunt of the sell-off, but pretty much everything weaker at the moment on the equity front. Now, we've got some important data, of course, coming out of the US. It is non-farm payrolls numbers. These are going to be very closely watched because we did have jobless claims and manufacturing numbers as well, really helping to catalyze the sell-off earlier today. Most labour market data has missed expectations this week. Take a look at some of the global movers as well. Yeah, it's a who's who of Asian equities that are getting beaten up at the moment. Here in Australia, for example, pretty much or every sector on the ASX in negative territory. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa up next. This is Bloomberg.